Welcome to the Property Couch, where each week you get to listen to two of Australia's leading property experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle channel, and Ben Kingsley, chair of Property Investors Council of Australia and the 2014 and 2015 Property Investment Advisors of the Year.
All right, folks, you're on the Property Couch where each week Ben and I bring in the insider's guide to property, finance and money management. Mate, do I even go here?
There were four. Good old Collingwood forever. They know.
No, keep going. Yeah, I do. Mate, it was funny. I haven't seen your cheeks go red before, but when you had a solo.
Yeah, all good.
Well done, mate. Well done.
Well, I think we'll be Mad Mondaying next Monday. I think
you said that last week. Come on.
No,
yeah. 1980, 38 years ago, was the last time these two teams played in a final. It was a grand final.
Yeah. And Richmond by 83?
Yeah.
Something like that.
Well, I just wanted to revisit that. So,
I think we play them 10 times, we might win 1 out of 10. So there you go. So I think the odds will be heavily in their favour, and they should be. They're the best team in the competition. It's theirs to lose.
Andrew said to me, "Can you get us a ticket for take the boys?" And I said,
"You Edicum?"
I said, "Let's work." I said, because she asked prior to the prior to you winning. I said, "Look, if GWS win, maybe. If Collingwood win, no chance."
Yeah. I don't even think with GWS you're going to be struggling. They've got over 100,000 members, and we've got close to 100,000.
Yeah, but they've got to travel. Yeah, but can you imagine like the two big teams in town?
Yeah, but look at the prelim last year. You couldn't get a seat to that, and that was all Richmond.
So there we go. Well done, mate. I'm sure you'll be excited this week. Okay, so mate, there's a little announcement about our book. You announced very generously last week, 30% discount.
30%.
Only way you can get 30% discount, Ben, is by being on our wait list.
Wait list.
Now, Stiggy tells us that the wait list expires tomorrow.
Tomorrow?
If you're not on the list...
Midday tomorrow or midnight tomorrow?
Well, I'd say midday, but I've said midnight.
She's too nice.
Because she's nice, gives you a little
bit
more
time.
She's too
nice.
If you're on that list by midnight tomorrow, you will get a 30% discount. Because what happens minute past midnight, Ben? The wait list goes.
Gone. Okay, so you will get that Friday the 21st
of September.
Well, so it'll be 11:59 if we're going to be technically correct.
Oh.
So 11:59, and then you will get emailed a code.
Yes.
That code gives you your 30% discount.
Saturday morning, we're going to send out the email with the code. It's the only way you can get 30%. So get on that list, folks. We want to get it to you. We want to get it in your hands. We think it's well worth it. So tomorrow, the 21st of September, at 11:59 and 59 seconds, Ben, it will expire. Get on it.
Get on it.
Hey, you had a good event this week.
Tuesday night, great session. The Picker meet-up session in Melbourne. Good turnout. Yvonne Martin, she knows her stuff. I mean, there's 130 changes that are proposed to the Tenancy Act, which are going to come into effect either on the 1st of July 2020 or prior. There's still a lot of unanswered questions like minimum requirements and definitions that we're still waiting to see. So as soon as we know what those definitions are, we are going to get Yvonne on the podcast. But for now, if you want to learn more about some of the big changes that are going to occur and what you need to prepare yourself for, my advice to you is to join up to Picker. So www.pica.asn.au/join, or obviously you can click on the show notes, because if you aren't a member, you're not going to get access to this really intelligent and important information. And you're thinking also that, it doesn't matter, I don't own property in Victoria. There is some other gold in here in terms of how you identify great property managers, what does a great property manager look like, such as Yvonne herself. They're the types of things that's also available. So, mate, I would say go and check it out. You'll be well rewarded, and join up for $5.
I definitely will, mate. No problem.
Now, what was the other big news of the weekend? Well, there was a little story on a particular TV show, 60 Minutes.
60 Minutes, yeah. Rinse and repeat on the... it's a bit of social media chat because of it, Ben.
Yeah, there's been a lot.
But what's interesting is they had 60 Minutes, they had Veronica was on the 7:30 report the week before. There's been a few headlines around, newspaper headlines. They had a particular...
AFR,
couple of guys that I met at the home buy show last weekend sent me an email to say, hey, look, so there's a bit of chatter.
It's got to affect sentiment. I mean, we don't like a standard property market. So the reality is, but this is not anything new to our podcast listeners who have been listening to us for several years. I mean, 2016, some period through 2015, we were talking about
winter.
Winter was coming, and we were talking about the fact that we didn't like what people were buying, and everyone was getting on the property market bandwagon, and there was FOMO. So the fact of the matter is, people are going to lose money. You know, some people are going to lose money when it comes to property. Some property prices are going to slow down. Other areas there's going to be opportunity. So for me, I don't see it any different than any other time in the history of Australian property where there's potentially going to be a slowdown and opportunity in some markets. That's what I say about all things when it comes to investing. There are going to be good areas. There's going to be areas that you're going to be able to find that there'll be a flight to safety. So when you go to those areas, and there'll be opportunities in those markets, just like in the stock market. There are good and bad areas, good and bad businesses, right? So from that point of view, you've just got to look at that. And even some of the best businesses get caught up in it because it's a self-fulfilling prophecy.
Well, isn't it interesting that the commentators are saying the market's going to fall 40% and it's catastrophic
for next year? One commentator was saying that.
But there's a chorus of people saying similar things. But it's,
the other chorus now lives, I mean, Steve Keen now lives in the UK, right? He's been banished from Australia.
But the point is, are we buying the market? Or are we even buying the lower north shore of Sydney? Or are we buying the inner east of Melbourne? Or are we buying the north side of Brisbane? We're not. We're buying, we've said this to the point of it being ad nauseum, you're buying a property in a localised street, in a localised suburb. And there's platitudes, like you can roll out platitudes of many, but how's this one for a platitude, Ben? When the tide goes out, you see who's been swimming naked, right? But none more than ever does that make sense now, because when a rising tide's lifting all ships, it doesn't matter what you buy.
No.
But it's now. So all you'd say to our listeners is, sure, like don't flippantly ignore some of these things, but just remember, if you've got a property that's obeyed all of the fundamentals that we've talked about for almost 200 episodes now, then when the tide goes out, chances are you've got your togs still on.
Yeah, look, and the reality from our point of view is we've got 20 plus years each of doing this, right? So we've seen these cycles before. We've seen the challenges through, the second biggest financial crunch globally ever seen. So from our point of view, that's where we do potentially see that opportunity. And I've always said to people, we're not making any more land. If we can get that land closer to the central business districts, that land's worth a little bit more there. What you buy there is what people want to be accommodated in. What I've also said on this podcast is I don't like the fact that there was 50% of people buying investment properties. I always thought that was too aggressive. I want it to come back to 30%. I want it to be more balanced in terms of, because owner-occupiers push the price up, not investors for the long term, right? So the price will always find its equilibrium where traditionally owner-occupiers are happy to pay, right? So from that point of view, it's like we'll let this noise roll through, we'll let this booming market follow through. But that's the reality. The ripple effect is real, comes from the centre going out. You can look at those council rates, you can look at the land values pushing out over the journey of time, and that's exactly what plays out. So
the biggest risk, isn't it, Ben, is if everyone was to act on the advice that was given in that program, and everyone did it at the same time, then it would become self-fulfilling. But if everyone doesn't sort of have that contagion fear and realise if you've got holding good quality assets, then some of those people out on the fringes that they did talk about are vulnerable.
They are. I mean, Louis Christopher, who was obviously from SQM Research, right? He's actually tweeted after the show and tweeted before the show, sort of saying, I hope they balance out what I responded to, because he was talking about, so they took his piece about the negativity, but he says, but here's the reason why it won't. Strong employment, strong population growth, all that was cut, right? That hit the editor's floor. So I retweeted his comments around the balancing side of that. So that's always the difficult bit, right? When you say we've got the real estate agent, we've got all these people, it's just one person's opinion, right? And Martin North, he's a data scientist, he's got his numbers, he's sort of saying that there's problems out in the fringes. We think that problem is more to do with property and more around money management. But I mean, I'll just give you some stats from, because we like to focus in on the facts. But outside of Darwin, Perth and regional areas like Gladstone, in terms of arrears or mortgagee in arrears, the actual market is phenomenally strong. Like in terms of, in the last quarter, so quarter 2 of 2018, the actual arrears rate dropped not actually went up. So Q2 2018, the arrears rate on prime RMBSs, which is basically residential mortgage-backed securities, dropped by 5 points down to 1.09 of 1%. Now the non-conforming, which is basically all of the riskier loans that have been, we saw that peak in 2009 at 20.9%. So basically 1 in 5 loans were going ordinary during that time. Guess where that is now? That's also down in the June quarter number 2. That was down 2.12% to 5.26. So that's significantly better than what we saw during those other times. Now, all being said, these arrears do take a little bit of time to be reported, but the reality is we're in a state where, we're feeling okay. Yes, there are a lot of people with interest-only mortgages. They are drying up, and there will be probably thousands of investors who might have interest-only loans that are moving. That 1,000, I don't know whether that's going to affect the 1.7 million property dwellings and the 10 million mortgages that are out there. I just don't see it happening.
And like what you're saying before we hit record here is that if they do roll over to interest only in the 6th year and then the 7th year for the 2nd year, that you have a scenario where some people may have to sell, right? To be able to fund the cash flow, and that was kind of highlighted on the
if you're going to gear really aggressively, that's your challenge, isn't it?
But the thing is, if you have bought the right assets and you do have to sell, it's not as if it's going to drop 40%. So.
Look, mate, people who have bought some off-the-plan apartments and some stuff that out wide and thinking that they've done a good thing, they're the ones in trouble here. We've made no mistake about mentioning that. Even, look, some of the higher end, really expensive properties, if we do see an economic slowdown, the other part of the market that suffers is that extreme, 10, 15% in that 2+ million range. And we've seen some of those come off as well.
Well, so from someone who's in television, Ben, I know what it's about to edit sound bites. I know how it is to move things around. I even know that in chatting with Veronica, she was on the 7:30 report a couple of weeks ago. And that sounded quite negative from some of the sound bites that they pulled from her. But I can tell you from conversations I have with her, she's bullish. She is well and truly in the fundamentals that we talk about, Ben, is if you've bought the right property in the right location, you've done it for the long term and you correctly finance it. She's of that view, but they've took those little sound bites in that 7:30 report as well. So it's important to know that, like what you said, Louis Christopher's now retexted to say here's the balance to it.
Well, the contagion is, what is the catalyst for a GFC? And we'll get into that, later on, but for another, round of that. Yeah, we've got a lot of debt globally. But what are owner-occupiers going to do? Are they all going to sell? And then they all turn into renters?
Yep.
So I'm trying to think of the human behaviour that will take shape. Yep, there's going to be those on the fringes, the 1 or 2% who might go, well, this is no good for us. We need to get out while the getting's good. And if that has a contagion effect, then what are they going to do? Everyone's going to rent, right? Everyone's going to rent each other's properties, and someone's got to buy them. And if no one buys them, if everyone wants to rent, rents are going to go through the roof. Yields are going to be up. That's what you live off. But so I'm not quite sure what that serves in terms of telling people that. Yes, were people over-aggressive? Yes, they were. Did property prices overshoot? Just like every boom they do, in every upside of the market. Are they going to come back 40%? Or I'd be challenging that. But Martin might be right in a couple of pockets of land sales in certain areas and, severely oversupplied apartment markets. I suspect there's definitely going to be 20+% corrections in those markets. But broadly speaking, I'm not sure. I wouldn't have thought so. I think the fundamentals are still there.
So there you have it, folks. A few people wrote into us. Hopefully that's let us know if there's any queries that you've got on the back of that. But today, before Q&A day,
Q&A!
We are at Q&A day. We know this is our favourite time of the month.
It is.
Q&A day. Hey, my Mindset Minute theme today, Ben, is a reflection piece.
A reflection piece.
So you should get comfortable because I'm going to reflect.
Take a seat.
I saw this when I was trawling Facebook the other day, Ben. Something that you'd be familiar with.
Are you a trawler?
Sometimes it helps me switch off.
Okay, fair enough.
Because it numbs you really quickly.
Yep.
Steve Jobs' last words, Ben. He died a billionaire at 56 years of age of pancreatic cancer, and here are his last words on the sickbed, Ben.
Right.
I reached the pinnacle of success in the business world. In others' eyes, my life is the epitome of success. However, aside from work, I have little joy. In the end, wealth is only a fact of life that I am accustomed to. At this moment, lying on the sickbed and recalling my whole life, I realise that all the recognition and wealth that I took so much pride in have paled and become meaningless in the face of impending death. You can employ someone to drive the car for you, make money for you, but you cannot have someone bear the sickness for you. Material things lost can be found, but there is one thing that can never be found when it is lost: life. When a person goes into the operating room, he will realise there is one book he is yet to finish reading: Book of Healthy Life. Whichever stage in life we are at right now, with time, we will face the day when the curtain comes down. Treasure love for your family, love for your spouse, love for your friends. Treat yourself well, cherish others. As we grow older, and hence wiser, we slowly realise that wearing a $300 or $30 watch, they both tell the same time. Whether we carry a $300 or a $30 wallet/handbag, the amount of money inside is the same. Whether we drive a $150,000 car or a $30,000 car, the road and distance is the same, and we get to the same destination. Whether we drink a bottle of wine at $300 or $10, the hangover is the same. Whether the house we live in is 300 or 3,000 square feet, loneliness is the same, Ben. You will realise your true inner happiness does not come from the material things of this world. Now hang in there. Whether you fly first or economy class, if the plane goes down, you go down with it. Therefore, I hope you realise when you have mates, buddies, and old friends, brothers and sisters who you chat with, laugh with, talk with, have sing-songs with, talk about north, south, east, west, or heaven and earth, that is true happiness. And then he closes out by saying these things: the best awarded words in London: eat your food as your medicine. My philosophy, yeah?
Yes.
Otherwise you will eat medicines as your food, Ben. The one who loves you will never leave you for another, because even if there are 100 reasons to give up, he or she will find one reason to hold on. There is a big difference between a human being and being human. Only few will really understand it. And the last one he said is, you're loved when you're born, you'll be loved when you die. In between, you have to manage. So if you want to walk fast, walk alone. But if you want to walk far, walk together. So here's the finale, Ben. The 6 best doctors in the world. Number 1, sunlight. Number 2, Ben, this is for you, rest. Number 3, exercise. Number 4 is for you, Ben, diet.
Beautiful diet.
Number 5 is self-confidence. And number 6 is friends. Maintain them in all stages of life and enjoy a healthy life.
Wow, thank you for those words of wisdom, Steve.
So remember, folks, we are trying to build wealth through property, but keep it all in
relative to personal
perspective.
Goals.
Exactly
right.
Thank you, Steve. Thank you for whoever posted that. I think it was Beverly that I found on the net. Hey, today's Q&A day, Ben. Our first one is from Darren.
Darren, take it away, Darren.
Hey there guys, Darren here. Love your show. Really getting a lot out of the podcast and been binging on that recently. Question: me and my wife, late in life, made a mistake, bought a house and sold it back in 2000, so we're not first home buyers. We're 50 now, looking to get back on the property train, and good income, about 180 a year, so we've got about $4,500 in disposable income that we can put into a property. So, given everything I've heard from you guys, how could a couple that are now 50 with that sort of available cash make their way through to give themselves a passive income by their mid-60s of about 80,000 to 100,000? We were thinking a house of about 450,000 perhaps on the north side of Brisbane. We're around Petrie, Kalanga area. And we could smash out as much as we could in a year and a half and then get some equity and then move on to the second house, maybe a bit of renovation in between. So my question is, a lot of being spoken about with people in their younger years, but how do people of our age group get onto the property ladder and make this happen for ourselves?
Great question there, Darren, and it actually pops up a bit, Ben.
Yeah, it does. Because the challenge here is that, this is the reality for a lot of people. We talk about finding financial independence and financial peace. It's harder to achieve later in life because you don't have the power of compound and that power of time. Remember, we talk about 4 levers: income, expenditure, time, and target. For Darren and his partner, their time is the challenging piece here. So in most cases, depending on whether you go and see a spruiker or a professional advisor, you may get mixed messages here as well. People might say, yeah, sure, I can make this really happen for you, and we're going to take a lot more risk. So that's what you've got to understand. Is so you need, Darren, you need to sit down. So income's great, but you do need to sit down and say, well, what are the important things for us? Because there's a couple of technical things that we need to understand here. If hypothetically, Darren and his partner, we don't know how much super they got, right? So there could be a big super there might be a defined benefit, which is technically an annuity in most cases. So that might give them some base load of income that they're going to get. Obviously the safety net is the pension, right? So Darren's talking about having 10 to 15 years to make this happen. Now the challenge with that is that, property prices, you really want that 10 years to get true maturity out of it. So Darren, I don't mind the idea that you're going to buy a home that you live in as your principal place of residence, because from that point of view, that is not assessed as part of your total assessable assets when it comes to pension. Okay, there's a good chance that given how much time we've got, that you're going to get some type of pension, because we may not be able to build that wealth base up. So that's the reality check in terms of if I was your advisor. So I don't mind where you're talking about in terms of properties north side of Brisbane going pretty well at the moment. House prices are moving there. Definitely something you could add value to create a bit of equity, and potentially getting an investment property that is a cash cow in 2, 3, 4 years from now isn't a bad idea either. The reality, however, might be that in terms of trying to achieve the $80,000 to $100,000 passive income without touching the asset base is highly unlikely. Meaning that, let's say we did buy one investment property in your mid-50s, and then even another in your early 60s, which I would have thought would be aggressive and would need to sort of have a really high risk profile attached to it. We might be able to sustain those properties up until such time as once you finish work, we might have been able to build up enough of a buffer where you can hold on to one of those properties for another 3 or 4 years before you had to sell it. And then you get a material gain from that property. Well, that material gain then forms part of your total assessable asset base, right? So that could affect your pension. So all of this extra work and risk that you've taken could actually be cut out by the pension impact in terms of what that story looks like. So for me, this is a perfect example of someone who needs to sit down with a qualified professional advisor and go through each of the pros and cons of what their story is. It may be better for you to buy that home, add value, which is great, and then look to add additional money to your superannuation, as an example. So there are some additional incentives for older people to add more money to super. Now that's good, because obviously that's a bit more tax effective than having the income in your personal name for later in life. So there's a lot going on here around this story, and this is common for most people. So you normally find people in their 50s actually finally get to sit down with a professional advisor. We would have said it would have been better 10, 15 years earlier, but Darren, as he admits to us, hasn't been able to do that. So it's a really important story here around Darren. Yes, having a principal place of residence, I'm a big believer in that. So in your particular case, I don't think rent vesting is an option for you, because again, you'll have all of this income coming in that you'll have to pay tax on, and it could also affect some of the pension story there as well. So quite a few moving parts. Sit down with a professional, go through those moving parts. But I do like the idea that if you do decide to pull the trigger on a family home and somewhere where you can add value to and build up some equity, and potentially one investment property in a couple of years' time may work for you, but it's all going to come down to sitting down with that professional. Now, word of warning when you do sit down with a professional financial planner, in most cases, they have a bias against property, okay? Because property is not a licensed investment product. In a lot of cases, they're not covered by their professional indemnity insurance to talk about property. So if you wanted to get a balanced story there, you might also then want to sit down and talk to a qualified property investment advisor and see what their story is in terms of if they're a fee-for-service advisor, which is what I prefer, because you're getting advice not necessarily tainted by their strategy or an incentive for them. So really important question. I'm so glad you asked it, Darren, and thank you for sharing your situation. Good, strong incomes. We need to do a lot of heavy lifting over the course of the next 10, 15 years for you to build up a wealth base that's going to sustain you through retirement.
Well said, mate. Property Investment Advisor of the Year there. But I think what's important is you said it at the beginning, make sure that you avoid talking to a spruiker, because the spruiker's not going to take the 30,000 foot view.
No.
And because a property decision this close to typical retirement age really needs to factor in the pension. I always say, let's bring it back to some frameworks. You know, if you want to have 80 to 100,000 a year via property, you need to have
Rule of 25.
The rule of 25. So just do 80 times 25, or easy for the maths, it's 100 times 25. It's 2.5 million worth of income producing assets outside of the family home, fully paid off, providing 4%. So that's why you're saying there's not enough time, because it's income, expense, time and target. Well, for these guys, their target is high for the time that's on, being allowed here. So a couple of things there for you, Darren, but clearly you need to speak to a specialist. Property investment, as Ben said, property investment advisor, but ideally a financial planner in the mix as well.
And I think even with property downturn at the moment, there's a lot of competition out there to talk with a good advisor, and so the businesses who get you to come in and talk to them might be desperate for work because of the downturn in the market. So that's the other thing you want to see is make sure they don't have commission breath, or they're not desperate. It's like, sit down, what's the best thing for me? They should be showing you some financial models. They should be giving you some indications in terms of what that looks like, so you can make some more informed decisions. If they can't provide you with any modelling or outcome, you're probably not with the right advisor in terms of showing them your potential and your opportunity.
Financial planners have a thing called an approved product list, and if things aren't on that approved product list, it generally means that they can't make the advice around that. So that's why Ben said earlier about the bias towards property. It's, I know a lot of financial planners who absolutely love property. So there's no agenda to drive away. It's just that, like you say, for their professional affiliations, if it's not on their APL, they can't make recommendations around that. So that's largely where the challenge comes, because I don't meet too many financial planners, Ben, that have a genuine bias away from property, because anyone who's got a material income generally wants to park it in residential real estate, which is usually their home. So most financial planners are talking to clients with a material income that's usually in their family home. So, but it's because of that approved product list.
And a lot of commentators who are in the financial services space do not talk up property. They give their assumptions on property on 1 or 2 pages or 1 or 2 comments, right? So we don't want that either. Obviously property over the long term has been a terrific investment, and if Darren and his partner feels really safe about that, I don't have a problem with that, but just be mindful that we think property is a long-term play, not a short-term speculative play, and especially in the current environment, if you did try to speculate, you're probably going to come out the other side short-changed. So it's best that you get those models done and make a more informed decision.
So Ben, just on closing, strong income though, with what they don't say monthly disposable income of 4.5, but if you assume it's a monthly disposable income,
I suspect that would have been 4.5 clear.
So that's probably their best friend, isn't it? To be able to just be retiring debt as quickly as they can.
And a financial planner might be able to come up with a strategy that says, here's a super strategy or a managed fund strategy. You've got to look at that on its merits. And then you've got to say to yourself, or what does that look like compared to an alternative, to see, and that's why it's all in the diagnosis. It's all in the clarify and evaluate stage for us in terms of making sure that it's the best decision. Because most people who we work with do have a bias towards property, and we are, we're very open about the fact that we have a bias towards property. So we're, when our clients come and see us, we still do shares and direct investments and managed funds and all those types of things, but most people who are coming to us like the idea that property is the vehicle, their preferred destination in terms of how they want to invest.
There you go, Darren. Hopefully that's helped. Feel free to give us a follow-up question if you need further clarity, but bottom line is you need to be talking to a couple of professionals in that case, and avoid being spooked too. Great question. All right, here's one from Steph, who says she's a serial coucher, Ben.
Oh, I like serial couches.
Hi guys, Steph here. I'm a serial coucher. Coming to you with a bit of a different question, and I know you've covered it a little bit in earlier episodes, but I'm hoping you can provide a bit more information and point me in the right direction. Essentially, we're looking to purchase a home from my father-in-law over a period of time. He's essentially an asset-rich, cash-poor retiree who's living fortnight to fortnight on the pension. And yes, it's certainly an emotional driver, but the asset does stack up. So I guess my question around this is, how does something like this work? Can you acquire traditional financing, or is it more of a specialty class of financing, and what specialist should we look to engage? I just want to get as much information as possible before we even broach the subject with him. Thanks so much for all your help, and from all the couchers, a big thank you for being so generous with your time and knowledge and sharing it with us. Thanks, guys.
Well, thank you, Steph. I appreciate that feedback. Ben, interesting, very interesting. So there's a couple of things here, not clear, but buying it over time suggests that we might be giving chunks of money to father-in-law over time rather than one hit. But this follows on to what you were saying, what we were saying earlier with Darren's question. Is it can potentially affect the pension because I'm not pretending to be a financial planner here, Ben, so this is just a generalised, bigger picture. But really, in terms of means testing for pensions, the only thing that's exempt is having a roof over your head.
Principal home. So
if you cash in some of that roof over your head, even if you've, let's just say, you got a $500,000 house, and you cash in 100,000, so you get 400,000 in value in your house and 100, so you still only have 500. You've changed the means test for the pension. So that's something that comes into here. So the two things that come to mind immediately for me is for Steph. She said, what professionals do we need to talk to? A financial planner. And the other one is a solicitor, because if they do go forward, they need to get into an agreement so that both parties are clear on what's going to happen.
So we'll talk about some statements of facts, not taking into consideration Steph and her father-in-law's actual financial positions. And the government, I'll make a broader observation here. The government are aware of this, right? Where we've got very, very high value homes and asset rich people, but cash flow poor people. And so the father-in-law, we heard some triggers there about being on a pension. So if he's on a full pension, it means, yes, he's got a lot of assets, but no necessarily cash flow. And in most cases, it's caught up in the family home. So the government has been sort of each year been tweaking at the budget to try and encourage more people to put some of that money away into super. So, if you sell your home and you get a surplus, that you can get some exemptions for one-off lump sums that can go into super. One of the things we were talking about with Darren is this total assessable asset base, right? So when you have a total assessable asset base, your principal place resident is exempt from that under the current laws. But so for a single person that owns a home, you can also have outside of your home $258,000 as a means by which an asset base before the pension is affected. Now, there's a lot of rules and a lot of moving parts to that, so I just want to give these as guides only, not as statements of fact. Also, for the non-homeowner, you can have, for a single person...
Actually, they are statements of fact.
They are statements of fact. Well,
as you said, not as.
Sorry, yes, my apologies. In terms of the information that we have on hand, you can also have $465,000 as a single who doesn't own a home. So we don't know how, this is a $2 million property. No wonder Steph and that want to buy that property because the property stacks up. But if it's a $450,000 or a $300,000 house, then it doesn't look like this is going to make much of an impact. So this could be a plausible thing. So what would you do hypothetically if that wasn't contained in terms of affecting your father-in-law's pension? There's a couple of ways in which you can go about it. If you want standard borrowings, you might strike an agreement whereby you're acquiring a percentage of the property. So let's say it's 10%. So we've got a $500,000 property, and let's say hypothetically they're going to buy $50,000 worth on that property. So they are going to have to pay stamp duty on that $50,000 that they're buying. They're going to have to enter into a contract. That contract needs to be provided also to the lender, and both parties are going to have to be on the loan. So the application to the lender is still going to have all of the owners have to be borrowers as part of that arrangement because they all hold an interest in the property. So we would have thought that you would want to disclose that it's a closely held transaction. So it's basically, some call it in specie, but it's a closely held transaction. So from that point of view, you want to make sure that the lender is fully aware of what they're getting into and they can understand what's going on. And then down the track, they might buy further amounts of that property. There's going to be further stamp duty that's going to be applicable as they take ownership. Now, what does that mean for a father-in-law, hypothetical, or someone who's selling that? That's obviously a cash amount. That cash amount goes into their total assessable assets, which could include cars, cash in bank, shares, whatever it is that they've got. So it's not just the family home. So if they've got assets over that value, it could affect his pension. So that's why, if we finish this off, go and seek professional advice on this.
A couple of things for the father-in-law, it's his principal place of residence, so selling generally doesn't incur capital gains tax, again to be confirmed with the accountant. A couple of things on finance. We could, if it was to buy it fully outright straight away, that's usually pretty straightforward for a lender. If you don't have the deposit or you want to buy 50%, you may want to do some form of vendor financing where they get an income from that as well, so that can help boost the pension if it's up to these assessable limits that Ben has said. So there's a couple of things for you to explore. And interestingly, the definition of granny flats, Ben, is different for this perspective than general perspective. So
Centrelink's definition, yeah, that's right.
So have a listen to this. A granny flat is often considered as a self-contained unit connected to a family home. While this is the real estate definition of a granny flat, the Centrelink definition of a granny flat interest differs from this. According to Centrelink, the term granny flat right or granny flat interest describes an agreement for accommodation for life, not a description of the type of dwelling. A granny flat interest can include various types of living situations that help people to care for the elderly family members. Centrelink considers a granny flat interest as one where someone, A, pays for a life interest or life tenancy. B, the life interest or life tenancy is in a private residence that will be the person's principal place of home. Centrelink also considers that there to be two ways to have lifetime right in a property. Life tenancy, the right to live in a property, and life interest, the right to use the benefit from the property as you wish. So for Centrelink purposes, it's not possible for someone to have a granny flat interest in a property they own or part own. This is because they already have a right to live in their home because of their ownership. So
we were talking about buying a percentage interest over time. You may not have to do that. You may be able to use this as a means. So in other words, if you could go and buy that property outright, then that won't necessarily affect the pension piece because of these Centrelink definitions. So it is a little bit more complex. That's why we're sort of saying get all of the facts in front of you. You've done some research. We've given you some more information. Again, we are not licensed financial advisors.
For the avoidance of doubt.
For the avoidance of doubt, Bryce and I are not qualified financial planners. We're qualified in other areas, but we thought we would share that information, these statements of fact, from some information we were given from our financial planning team, to be able to share that with all of the listeners. And the last thing I'd say to you, Steph, is circle back to the first 25, maybe 30 episodes. There's I think it was the very original one we did with Peter Kalouzos, Ben. Yes. He talked about Poppy, where he has agreed to buy a agreed price for an asset, and then provides an ongoing annuity to the person who's given him that agreed price, and at some point in the future has the right to buy that asset at the agreed price, which may be agreed to 15 years earlier, Ben. Yeah, so it's a vendor financing type term, but it's a win-win for both of those parties. Yeah, it means that the pensioner, in that case, because Poppy stands for Pensioner Ownership Plan. Something along that, yep. So they get the cash flow when they need it, and then at some point in time, that cash flow is turned into an opportunity for the person to buy it at a pre-agreed price. So maybe that might help as well. So there you go. Thanks, Steph. Great question. Who's next, Bryce? We have Alistair, and here is his question.
Hi, Bryce, Ben and Ivis. Thanks for your show. I've got a question about LMI. I'm looking to increase my property portfolio from 2 investment to 3 investment properties, and possibly a 4th. My question relates to LMI. I'm sitting at around about 90% when I get my loans. I read somewhere that around the $1 million mark gets difficult, and that a global portfolio, it's impossible to get over 2.5 million. Can you speak to that idea?
Alistair, we can speak to that idea.
We can speak to that idea, and if anyone's interested in learning how LMI is calculated, there are some free LMI calculators from Genworth and the like in terms of being able to go in there and do those calculations. So let's start with some basics on lender's mortgage insurance. The first one is it's scalable, right? So it usually kicks in over 80%. For some special people, such as medical practitioners and so forth, they can also get exemptions up to 90%. So the reality is, as it scales up in two ways. It scales up by loan to value ratio, so the loan amount compared to the value of the property you're doing it, and it also scales up in terms of borrowing ranges. So usually there's ranges from 0 to 300,000, 300 to 500, 500 to 750, 750 to a million to 1.5, 1.5 to 2 million. Now, and then
keep going.
No, that's enough. and then we've got the percentages, and they creep right up there, right? So if you're thinking, I reckon there's a threshold in terms of what you want to go to be able to, the worst one I've ever seen in terms of a calculation we did for one client was about $42,000 in LMI premiums, and I just thought to myself, that's another stamp duty.
Yeah.
So, that's...
Embrace it when you have to, avoid it when you can. That's avoid it when you can.
So you're talking upwards of 2 to 3% of the value of the property. So all of a sudden, it's got to gain that percentage to get that back. Now, if you're a long-term investor and you're a highly aggressive investor and you've got a really high risk profile, good to yourself. But I also think in terms of what he's trying to say, what Alice is trying to say here is that the lenders are getting better at knowing all of your lending. You're meant to disclose it all, but under the sort of positive credit laws that we're seeing coming in now, they're going to share a lot more of that information, right? So if you're not telling the truth on your loan applications, you're committing fraud, right? So please don't do that because you'll end up in jail, right? But the other point of that is that they will know, in terms of how many LMI policies you've got out there and where your risk is. So they may not have an appetite to be lending you to that level, even if you've got good servicing capacity there as well, because lenders are getting more and more attuned to their regulation requirements around responsible lending practices. So for me, I'd be sort of saying, yep, if you want to go up to those 90s, you can still do it. You've just got to shop around to those lenders, but you've also got to understand that there's a big cost to do it.
Big cost to do it. Thank you for your question, Alistair. In fact, thank you, Darren. Thank you, Steph, the serial coucher, and of course, Alistair. Today, Ben, our life hack is actually brought to by our third question holder there. Alistair has actually given us a little bit more gold.
Thank you.
A little bit more value. Here we go.
Hi guys, it's Alistair again. I just discovered if you use Google Contacts and you save all your contacts in that, and then when you go into Google Maps, you can just type in the contact you're after and the address is saved.
So that means, Ben,
as a business.
Well, it looks like if I type in the person's name into Google Maps, and I've done what Alistair is talking about.
Yeah.
I type, if you're in my contacts and I type your name, bang, it'll pull up your address straight away.
It knows where I live.
Yeah.
Ooh.
Yeah.
That is interesting. I thought it might have been a business thing where that makes sense. I've got a business name in my contacts that'll give me, because this is the intelligence bit that we're going towards. This is that personal assistant that I keep warning everyone that in 5 years' time we won't be able to do without. This is the early stages of that. Put your contact list in. I need to go to Bryce's house. Take me there, Google Maps. Interesting.
Ben, Bryce has put an embargo on you coming to his place. So you're actually, mate, you asked you the other day, you roll over, just talk to Google, don't you? You ask about the news and the weather.
Yeah,
and
I've got my little Google Home sitting next to me, and I wake up in the morning and I say, hey Google, what's the news of the day? And then I ask for the finance news. And so as I'm sort of stumbling and waking up, ask the time first. Yeah. What's the time? Then I said, okay, well I better get up. What's the news of the day?
Ben, you're sleepwalking, go back to bed.
And then my boys come in and then we have a quiz game. So we play the quiz. Yeah. So there's 5 questions in the quiz. They ask how many people are there. They give you a name. So that, and then I jump in the shower and then they start saying, hey Google, tell me a joke. And then they get the joke and then they run in and say, Dad, how about this one? So it's, lots of fun. We have lots of fun with our Google Home.
Okay, all right.
By the way, we're not sponsored by Google, but if you Google, if you're listening, we're happy to,
happy
try out any of your new devices.
We are happy to try out new devices. So there you go, folks.
Well, great life hack. Thank you for that, Alistair.
Q&A day, Ben. We love it. So here's the bit where we all hold with bated breath. Everyone's sitting there going,
oh no,
has he got one? Ivers is thinking the same. I'm thinking the same. So over to you, mate.
Okay, well, look, you know how you like to say, you don't show the secrets in showbiz. I'll just continue on with the whole Google thing. Oh. You know how you've got,
talking long?
Chrome. No, I haven't been talking long. You've got Chrome in there. And so ask Google a question.
Yeah.
So I just click a button and it has a question and gives me the answer. Like random questions with random. So I've got 3.
Okay.
So here we go. The typical male human body contains 15 trillion cells.
It's a lot of cells.
That's a lot of cells. So
we're all trillionaires.
So when I think, oh, that's interesting, and I skip the others. Next one. The oldest person.
Yes. Bet you they're from Japan.
Nice work, Bryce. Masao Okawa.
Right.
Masao Okawa.
Oh, you turned it into French, did you?
No, well, I'll get to French in a minute. Okay, here we go. 116th birthday in March.
Woo.
But the oldest recorded person was Jean Clement. There you go, there's my French. Jean Clement. And she was from France. Français. And she was 122 before she died in 1997. So she's the oldest recorded person that they can validate her story. So yeah, 122.
How far do you reckon you'll get?
Oh, 50.
Yeah, that's right. Mate, there's a bit of longevity in my family. My great grandmother got a letter from the Queen at 100.
Yeah, nice.
My dad's dad got to 93. His brother got to 100.
Ooh.
My nana right now is at 90, not out. So, mate, there's...
well, if you keep picking on my football team, you may not make it.
But if I keep eating grass, I might still get there.
You'll get there. Hey, speaking of green things...
Oh, Granny Smith.
Granny Smith apples.
All right.
Where did Granny Smith apples come from? They were discovered in Australia. In 1868 by Maria Ann Smith. Maria Ann, Granny Smith. Granny Smith.
Okay.
So there we go. She found a seed by the creek of her property where she years ago used to toss French crab apples.
Oh.
She grabbed that seedling, put it in the ground, created these light green apples, and then she cultivated them, and basically that was where we got Granny Smith apples from.
Okay.
There
That's
we go.
important.
1868. Did you know, Bryce?
I did not know, Ben.
There we go.
Now we can
My job here is done.
Your job here is done, Ben. Here we go.
We're dropping the mic.
Drop the mic. Well, folks, let us know what you think of Ben's Did You Know?
Yeah, I think next year we're moving on from Did You Know?
Yeah, we've got a new segment coming up for the third 100, haven't we?
We do. We do.
Well, that's a little bit of there.
We're not going back to sign-offs.
No, safely.
Safe.
Yeah.
Safe.
But, I was so sad about that. So, but what I can say, Ben, is no one has ever...
You're saying this again?
Speak piped.
Oh.
You were Did You Know? So
that's a good point.
So of all the Did You Know stats out there, let's get one for you, mate.
Beautiful.
What did you think I was going to say again?
Well, that was the worst one. That was the latest one you've ever done.
Now you're revealing all my gags, are you?
I've known you long enough.
All right.
Knowledge is empowering, but only if you act on it, bro.
See you next week, folks.